Welcome to the Market Mindset. We are the hub for news, results, and CEO interviews focusing the junior commodities sector. We provide market analysis and perspective that will help position you for solid returns. If that sounds like something you're interested in, you can help support us by liking this video, subscribing to our channel, and clicking the notification bell. For more info, you can visit our website. All links are in the description below. Now let's get into today's video.
Hello, Mr. Kilic. It's great to meet you. Welcome to the show. How's it going?
It's going great. Thank you for having me.
Really looking forward to having this conversation. Where to begin? Let's just actually, you know what? Good place. Let's start with the name change because I think that kind of puts everything into context.
Yeah, so HIVE Digital Technologies is going to be our name going forward. It really reflects our direction as a technology company. We've sort of evolved with where we see a lot of demand and growth for the type of computing resources that we offer. Hive has always been known as being one of the world's largest Ethereum miners. And as far as the big publicly traded crypto miners, we were, I think, the only well-known Ethereum miner. We were, north of 1% of the network. And that is significant for numerous reasons. One is it was a very high margin business. Ethereum mining had better profit margins than Bitcoin mining. What I mean is, I think at the peak you may be seeing Bitcoin mining revenues around 30 cents a kilowatt hour if you were running new S19s. But with our fleet of NVIDIA RTX series cards, we were seeing revenues north of 75 cents a kilowatt hour, even 80 cents a kilowatt hour. So well over double. And so that is, but at the same time, your operating costs are similar. So it just goes, your gross mining margin was so much higher with Ethereum. Now, there was a lot of naysayers that said when the Ethereum merge came, our GPUs would turn to bricks, which was totally untrue, which I knew was untrue. And we would try to explain this that, when you have a displacement of hash rate and all the hash rate moved to the other GPU mineable coins, what happened, it's not like things went to zero. Everything's asymptotic, right? So it can approach zero, but it won't quite get there. What that means is proof of work mining on the different blockchains will have some revenue per kilowatt hour that they will pay out. And the miners who cannot mine profitably at those levels will fall off. So while certainly there would be less miners, when we had, best in class operating hardware and infrastructure, very low competitive energy prices, last year we were seeing energy prices in 1 and 2 cent per kilowatt hour range in Sweden. It's not always at that level, but we saw it at that level, and we've hedged a bunch of power at 3 cents. We have fixed power prices around 3 cents, 3.5. It gives us the ability to continue to contend and operate. And that's exactly what we did after the merge. And so now what's happened is, we saw rallies in some of the altcoins, which again, we mine altcoins with our GPUs. We don't take custody, they get sold. We take custody of Bitcoin. And we'll sell that Bitcoin because all the Bitcoin on our balance sheet is green and clean Bitcoin mined from our ASICs using green energy. The last quarter of our fiscal year, March 31st period end, being reported on, we saw about $250,000 of revenue coming from our GPUs doing HPC, high performance computing, so not crypto mining. So what my team did in the first 3 months of this calendar year, and keep in mind the merge was September 2022. So from January to March 2023, we did $250,000 of revenue doing HPC. And this is just with 80 kilowatts of power, right? And that was for the whole quarter, but it's not like they were all running from January 1st. It was kind of like, mid-February to end of March. And so if you do the math, it was working out to something like $1.50 a kilowatt hour, $1.50 a kilowatt hour, right? And again, Bitcoin mining right now, by the way, with S19s, you may be looking at 11 cents a kilowatt hour.
Yeah.
So we're talking almost 15x.
Yeah.
Right. Almost 15x. And so this is again where, sure, there's the naysayers, but we're about showing and proving, at Hive, we mine for profitability. What's the most effective way to deploy our resources? We have numerous resources. We have our capital, we have energy as a resource, which we deploy. either to mine with ASICs, mine with GPUs, or sometimes we hedge and sell it back to the grid. By the way, we made $3.2 million of profit in December of last year selling power back to the grid when spot prices were skyrocketing and we had locked in our contracts, which, by the way, utility providers happy that we do that because now they have electrons they could sell back to the grid and they're still making their margin as well. So it's all about understanding your resource allocation, and then other resources, our technology stack. So our technology stack, now we're focusing on building our AI vertical. And so that's multifaceted. So the NVIDIA GPUs that we bought are data center grade GPUs that are capable of doing high performance compute. And this is very different than some of the other crypto miners that bought GPUs to mine Ethereum that only had a single function, like the CMP series, right? Which I don't want to name names, but other crypto miners out there that are publicly traded invested in the CMP series. Those are stripped down and they don't have any other function beyond Ethereum mining. They're cheaper to buy, right? But they don't have the other functionality that you need to do more comprehensive HPC workloads. We bought the NVIDIA A40, the A4000, the A5000, and the A6000. And so these GPUs have the ability to do HPC and AI. Now, we did $250,000 in that that last reporting quarter of our fiscal year, first calendar quarter. And from here, we're just trying to scale it. So to really get the most out of these GPUs, we're upgrading the servers, the CPUs they operate in. And so we've partnered with Supermicro, and it's very exciting. We have ordered 80 of the high performance servers that they come in. They've got Intel 6342 processors, 96 threads, a lot of room for virtual machines, a lot of resources for virtual machines. And each server holds 10 GPUs. So these will allow us to run 800 of our GPUs. And as we expand our orders, that will grow. So just to put it into context with the here, I'll actually do a little screen share for you. This was actually in our earnings webcast. So with just 4,600, we have 38,000 NVIDIAs, right? With 4,600 of them, if we just look at our A40s and our A6000, we have 4,600 cards here. Using a 75% usage ratio, because when you're doing AI or HPC, it's not like crypto mining where all your hash rate is earning revenue all the time. It's people need to book or utilize your GPU. So we refer to the usage ratio. So we've been finding about 75% in the marketplaces we've been working with at a nominal 50 cents per GPU per hour. These 4,600 cards would be doing 15 million a year in revenue, you know? And the thing is we already have all the GPUs. All we're doing is buying the servers. So for example, 4,600 GPUs would equate to 460 servers, right? And so that's shown here. The 460 servers would cost us about 6 million US, and that would generate us a gross revenue of 15 million. So you could see how that is, it's like a 4 or 5 month ROI for us to receive the payback. And so it's a very exciting time. Now, if you say, well, what if you look at the entire 38,000 NVIDIA cards that we have? What if they were all doing AI workloads? That would work out to approximately $120 million a year, right? So we're talking big potential. Now, this is our blue sky potential. I put this as the 4,600 cards. This is striking distance, blue sky AI opportunity. We've already got 80 kilowatts of servers running. They've done $250,000 a year of revenue. We have another, I guess, the 80 servers that we've got coming in, that's going to be about 300 kilowatts of load. So we're incrementally increasing. We're working with 4 different marketplaces where these are being deployed. And so this is very much, we hope to realize, I would like to realize these sort of revenues this calendar year if possible, right? We need 460 servers. We've already ordered 80. So, we could get with 80 servers a month by the end of this year, we would have enough hardware to realize this income. And what is more on the potential side, the bigger blue sky would be if we converted the entire fleet of NVIDIA data center GPUs to 120 million a year of revenue. Now, In the meantime, they are mining the altcoins, like I said, which again, the altcoins get converted into Bitcoin, and then we sell those. So it's all about being resourceful and adaptive with how we utilize the resources we have to realize the best operating margins, right? What is the how can you mining is about economies of efficiency. It's not about economies of scale. We saw a lot of big miners almost go bankrupt in the bear market last year because people overextend themselves, they take on debt, maybe they leverage their Bitcoin, and we haven't done any of that at Hive, right? It's all about growth with efficiency, right? What is scale without efficiency is the way I like to frame it. Because if you've borrowed a bunch of money to buy ASICs, or you've borrowed money against your Bitcoin hodl, and now you're paying 18% interest, and you have that coming off the top of your operating margins. Well, guess what? The Bitcoin mining revenues go like this, right? It's all over the place. That's just the nature of hash price, right? So if you're trading down here and your cost of operating, just your your data center cost, right? Your cost of goods sold is here and you're barely breaking even. If you also have debt to repay and you're in the red, you're going to be bleeding, right? And so it doesn't matter how big you are, it matters how much unit profit you can make. And then you want to scale your unit. If you've got a business that's profitable on a unit cost basis, then you want to scale that, right? Other things that we'll do, we will actually modify the firmware of the machines we have. We'll look at the revenues of where the health of the Bitcoin mining network is, right? You can obviously overclock machines, which means you get worse efficiency because they run hotter. Now, what is that trade-off? I can't just categorically um, state what is better and what you have to analyze it day by day. Where's the Bitcoin price? What's the network hash rate at, right? What's the joules per terahash of your machine? Are you better off running machines at 38 joules a terahash doing whatever 80 terahash, or do you want to downclock them to eight to say 70 terahash, but get their efficiency down to 34 joule a terahash? Well, how you find that out is you look at your unit economic. What is the network paying out? Right? What is your revenue on a dollar per kilowatt hour basis, right? And it's so key to look at a dollar per kilowatt hour basis. And when you do that, then you compare, once you've mastered that, which we've done for ASICs, then you can look at that for your GPUs, because the GPUs have so many different applications, right? Are you
Yes.
going to mine altcoins? Are you going to be doing AI? Because you have a finite amount of rack space, right, at any given time. Obviously, we're constantly growing and acquiring more data centers, but your rack space is a resource. What are the most valuable usages of your rack space that you can, in terms of ASICs or GPUs, that you can be operating? So that's how you have to think in order to have the best operating margins in the business. When you look at a company like Hive, this is a really compelling um, summary that because we have a different fiscal year end than some of our peers. So if you actually look at this period end December 2022, and do another screen share for you, our year end is March 31st. But if you just add up our quarterly, January to December 2022, which you can do based on our public filings, and you compare it to our peers, you look at what our yearly revenue was. We did $138 million. Okay, great. You could see our peers at 130 million, 142 million, 150 million. So you could kind of see the span, maybe between 130 to 150 million is where most of our peers were operating. You had a couple outliers here, but that's fine. Then you look at the cost of goods sold, which is the direct operating cost of your data center, your electricity, your staff, maybe any real estate expenses, etc. And you subtract these two, and that's what your gross mining margin is. Now, all the big public crypto miners report gross mining margin as a non-IFRS metric. It's great because it says how much money is your core operating business actually making. And you can do that math. You can see we're about 70 million. You got a couple of our peers, 90 million, 80 million, 82 million, a couple lower here, 45. And, we even have one that was in the negative. Okay. I mean, that's a little uncommon. Usually you would expect the gross mining margin to be positive, because guess what? You still have your corporate operating costs, your G&A after. G&A is general and administrative costs. D&O insurance, lawyers, auditors, salaries, et cetera, traveling, going to conferences. So usually crypto mining is supposed to be a healthy margin business, and you've got all these costs with being a pubco associated. So it is, it is a bit of an outlier that there's a couple companies here that are near zero or negative gross mining margin, but we'll just leave that for now. Let's just look at the corporate operating cost of G&A. And if you take that number here and subtract it from the gross mining margin, then you arrive at what I describe as corporate income. So what is the business actually doing on a cash basis? It's very key, because when I talk about on a cash basis, we're leaving out all the depreciation. Why? Because depreciation is a non-cash charge. Impairment is a non-cash charge. This year, we've had to impair deposits. We've had to impair the value of ASICs. We've even had to impair the value of real estate assets, right? And having depreciation thereon. So all companies have different depreciation impairment schedules, because it's up to the auditor. What is the auditor comfortable with signing off on? We depreciate our ASICs over 2 years, even though their usable life cycle is 3 to 4 years, sometimes 5 years. But we're just conservative that way. So it shows that our depreciation schedule, which again is a non-cash charge, is a lot more aggressive. So when you look at our net income, that includes all these non-cash accounting charges, it skews things. So you can't do an apples to apples comparison from different crypto miners, as everybody has different impairment schedules. So let's take out the non-cash charges and let's just look at the cash charges, which are your revenue, your gross mining margin, and your corporate G&A, right? And when you do that and you look at the resulting corporate income, you could see here we had 55 million of corporate income. Our peers here had 32 million, they're 15 million. From there, the other remaining three companies were actually negative. They're actually negative, right? So that is very interesting. So amongst our peers, we had the highest corporate income. Not on a unit basis, by the way, but broadly as a company, we on a cash basis, our corporate income was $55 million last year, right? And so when you look at that, you could look at the market caps. Now this was the market caps changed, but I did a snapshot as of May 17th. Our market cap was 250 million. You can see our peers here, 500 million, 300 million. So if you say, hold on a second, what is the market cap of a company relative to its actual corporate income? What kind of premium are these guys trading at? Our market cap relative to our corporate income by far was the lowest from our peers, 4.5 multiple. From there, the next lowest one was double, 9.8. From there, almost 4x. One of our American peers here has a almost 40x multiple from where we are on market cap relative to corporate income, right? And why is it?
Yeah.
When you look at 2 billion market cap and you look at a corporate income of only 15 million a year, right? And then you have others that are even in the negative. So this is all based on public filings, right? Go look at CDAR in Canada, or go look at the SEC EDGAR in the US. So again, it's all about having the best unit economics so you could scale a profitable business.